Stocks. What are they and how does the market work? Complete beginner's lesson. Stocks, market, investors, the world of business. But what is this thing called stocks? How does the market work? What about the companies and investors? How is it related to the market? First, let's look at their definitions in our friend Google. Stocks, a share which entitles the holder to a fixed dividend whose payment takes priority over that of common stock dividends. Market, to advertise or promote something, and investors, a person or organization that puts money into financial plans, property, etc., with the expectation of achieving a profit. Literally, these are the basic definitions of all of these. And why am I saying this? Because we're gonna be starting from zero because this video is for complete beginners about how the market works and what they are. Let's just get right into it. To understand what stock is, let's go back in time and do a little history lesson. The origins of the stock market started way back in the age of Christopher Columbus, when a group of enterprising Dutch merchants wanted to send huge ships over to the New World to start trading spices, silk, and all kinds of other foreign exotic goods. This required lots of capital that no single merchant could come up with on their own. So, groups of investors started coming together to pool their money and become co-owners in these trading companies. These ventures were called joint stock companies, and shareholders started buying and selling their stock with other shareholders and investors, and thus, the stock market was born. So, is anything I'm saying making any sense to you? If yes, then give this video a thumbs up. The idea was so successful that joint stock companies started popping up all over Europe. As the volume of shares and number of companies increased, it became critical to have some sort of organized marketplace to buy and sell these shares. So stock traders started meeting up at a London coffee shop, which became the centralized marketplace to buy and sell shares. Eventually, they took over that coffee shop and changed its name to the stock exchange. So that's how the first stock exchange was born, the London Stock Exchange. Today, there's stock exchanges all over the world, with the NYSE and the Nasdaq being two of the largest and most important exchanges. Okay, so that's it for our little history lesson. Now you know that a stock is a piece of ownership in a company, and its origins came from the need to pool money together in order to fund big business ventures. This concept of pooled ownership in businesses is what makes it possible to build huge companies like AAPL, WMT, LUV, and KO. It takes billions and billions of dollars to build a company like that. And most people don't have the money to do it on their own, unless you're Elon Musk. Elon Musk started Tesla on his own with $70 million of his personal money. But even Elon Musk eventually brought in outside investors in order to keep scaling the company. So, on June 29, 2010, he did what's called an IPO, or Initial Public Offering. An IPO is when a private company first starts offering its shares to the public. Before the IPO, the only way to buy shares in Tesla was to call up Elon Musk. But now, after the IPO, Tesla's shares now trade freely on a stock exchange. So anyone who has a brokerage account can buy stock and become a part owner in Tesla. So that's the difference between shares of private companies and shares of public companies. You generally can't buy shares of private companies because there's no centralized standardized place to buy them. But anyone can buy shares of public companies easily and conveniently. So, the stock market is where you can buy and sell shares of these publicly traded companies. Most companies start out as private companies, and when they get big enough, they can do an IPO and become publicly traded companies. Notice that I'm using the word stock and shares interchangeably. They basically mean the same thing, except that shares are the units of measurement. So, you would say, I own a stock in Tesla, or you could be more specific and say, I own 50 shares of Tesla stock. So, now you know that a stock is a piece of ownership in a business, and you know that the stock market is made up of shares of publicly traded companies. Now, let's talk about stock prices. Market cap is the total market value of a company's outstanding shares. So, for all of the investors out there who own AAPL stock, their shares collectively are worth $861 billion at the current price stock of 187.41 US dollars. So that means for 187.41 US dollars, you can become a 0.0000000002% owner in the company. Or if you're a big institutional investor and you bought 100 million shares of AAPL, then you'd become a 0.02% owner in AAPL. So it's all proportional. So the stock price reflects whatever people want to pay at any given moment to own a slice of AAPL. The stock price is very volatile. It moves a lot all the time, 24/7, and movements in stock prices often have nothing to do with the actual earnings potential of the company. So I want you to keep that in mind. The stock price is very unpredictable in the short term, while the company's underlying value and earning potential is much more stable and predictable. Let's quickly go back to the story of our Dutch merchants. Their trading company is absolutely killing it and they're making huge profits. There's 10 shareholders, which means the profit gets split up 10 ways, putting $100,000 in each shareholder's pocket every year. If one of the shareholders offered to sell you his piece of the company for $100,000, would you do it? The answer is hell yes! Since each shareholder gets $100,000 every year, if I buy his piece of business for $100,000, I'll make back the purchase price in just 1 year. Now, what if he offered to sell it to you for $1 million? Then I'd have to think about it some more. For $1 million, it would take 10 years to make back the purchase price. And that's if the company is still in business for 10 years and nothing bad happens. The moral of the story is this: the price of a stock is driven by the company's profits. Stock prices go up and down because the market thinks profits will go up and down. Profitability is the foundation of what creates a stock price. This is how it works in the long term. But in the short term, sometimes stock prices have no connection to profits. For example, right before the dot-com bubble crashed in 2000, there were internet companies with no realistic prospects for revenue, but they were trading at sky-high prices. This happens when market participants who lack knowledge get greedy, and this happens more often than you think. I want you to be very aware of this. Stock prices that have no connection to profits are ultimately correct. It might take a while and you might even get lucky and make a quick buck or two, but stock prices always come back to true value, which comes from a company's profitability. This goes both ways. If a company's stock price is too low relative to its profits, then the stock price will eventually go back up. Benjamin Graham, one of the greatest investors of our time, explained this concept in his book, The Intelligent Investor. He said that in the short run, the market is like a voting machine. So it's a popularity contest between the hot firms and the not so hot firms, and it's all depending on the opinions of the general public. But in the long run, the market is like a weighing machine. It's very precise, and it assesses the real substance of a company. So, if there's just one thing you take away from this video, let it be this: what drives stock prices in the long run is a company's actual underlying business performance and not the public's emotional opinions about the company in the short run. And there you have it, everything that you need to know about stocks and how it works. If you learned something from this video, leave a comment down below so all of us could read your thoughts. Also, if you're new to the channel, don't forget to click that subscribe button to be part of our growing family of money makers. This is Finance Boss. See you next time, awesome people.